Welcome to Markets Now. I'm Michelle Roque with Shawn Hackett with Hackett Financial Advisors. We're seeing mostly higher prices today after a washout the last couple of days. The one exception is the corn market, but we also have crude oil to the plus side. And Shawn, I want to start off talking about corn. New contract lows in March and May. I think the December hitting some 3-year lows, but talk about why we're seeing pressure there while the rest of the complex is trying to recover today.
Well, I mean, I think, we know soybeans have tight balance sheet here in the U.S. We know that the weather in Brazil right now is most impactful for soybeans. And I just think that if you're looking at the wheat market, it got so beat up yesterday and the shorts are so big going into the end of the year that it's almost hard, I would never say never, but I mean, it's almost hard to think you could get any more short as a percentage of open interest. We're at record levels. We're just daring the market to short cover into the end of the year. Corn is a little different. The balance sheet's pretty solid here for the U.S. We got plenty of corn. Brazil still has plenty of corn left over from last year's crop, and we're not yet into the thick of second crop corn where you're going to worry about production just quite yet, although that is coming. So it just leaves little reason to get excited about corn right now when you have issues with soybean weather and issues with maybe Russia pulling back on their export quotas, which they are making rumblings about here recently, as reason for the wheat market to maybe think that it's done enough on the downside, at least for now.
Yeah. December contracts go into delivery on Thursday. So in the case of the corn, was there some forced hedge pressure here as well that hit the market?
There's some worries about some large deliveries. For sure, I think the market is there's some pressure on who's going to get caught taking deliveries against the contract and that sort of thing. So a lot of that kind of technical pressure can come into a market that's well supplied. I think once we get through, that delivery period, I think we can get the speculation back into the market. And from what I see down in Brazil, the speculation could be pretty exciting if given how late soybeans are getting planted and the kind of dry conditions in Mato Grosso, which represents close to 70% of total corn production, we could be looking at a crop that's way, way down. And with a situation where exports next year from the U.S. could be considerably better if Brazil doesn't have that kind of supply to send out to the market like they did this past year. So we're very much feeling the corn market is scraping the lows just above 450 support, which we think and have said all along would hold going into the end of the year.
Yeah. So talk about that. You mentioned long-term support there, and how confident are you that that's going to hold here?
Well, because I'm very, very there's a lot of clarity in our work on the Brazil weather situation. I'm pretty confident that's not going to break. If the Brazil situation looked like good weather, then I actually think it probably might not hold for a little while because there'd be no reason to do it. But I'm really solid in thinking that the corn crop is in big trouble. And once we get into January, we're going to be looking at late planted corn, lower acres, dry subsoil moisture, drought continuing. And I just think with that out there, I don't believe the corn market's going to be comfortable discounting corn below 4.5 until it gets a clear answer on what that looks like. In years past, when we've had this kind of a hot, dry start, albeit this is the hottest, dry start ever, we've seen corn production in Brazil fall anywhere between 15 to 25%, which if it occurs again this time, that would not sit well, and it would not constitute a corn market staying near 4.5 for sure. We'd have to see some kind of a weather premium put back on, especially as we go back to La Nina during our growing cycle and the problems that will bring.
Okay. You mentioned off the top, soybeans seeing a little corrective buying, but really we're holding Brazil weather premium in. How much weather premium do you think that market needs to have in it, the soybean market?
Well, we had pumped the market close to 14. We took a little bit of weather premium off on the idea that some rainfall might be coming in here in December. The problem with soybeans is this. It's a half and half. Half of it's grown in the south where they're getting all kinds of rain, and the other half's grown in the north where they're not. And so it's always hard to say soybeans are going to have the kind of crop shortfall that corn, or most of it's grown in the north. I think right now, I personally believe with what I see happening that probably a market closer to 14 is the appropriate weather premium until we get an answer on exactly how bad is bad or how good is good. We backed off from that, but I think these ranges that the market's talking about are going to underperform. There's a thing called subsidence where you have dry, hot soils. It tends to create rainfall that underwhelms over and over again. And I don't think these rains are going to deliver on what the weather models are suggesting. Hence why I think we need to put some weather premium back on. And maybe today is the early start of the process of putting that back on that we took off late last week.
Yeah, no doubt. And hopefully that will help the rest of the complex, as you pointed out. Wheat market, you said you think we forged a low. So my next question for you is record short position here by the fund community and all three classes combined of wheat. What is it that gets them to actually cover those shorts and maybe gives us a better or bigger rally?
Well, I think there's two things. We know that there's a lot of position squaring that likes to happen in the last month of the year. And when you're this short, everybody has profits on the short side if they were shorting it all the way down. And they're going to want to book those profits. It's just a technical thing. They want to book them. And so I think that we're going to, just from that point alone, we probably can get a strong short covering rally into the end of the year. In addition, we continue to hear rumblings and thought processes about Russia withholding or reducing their export quotas from what they had last year, meaning they're going to sell a lot less wheat. And that's a big change in the market. And I think over time, as that reality becomes more ingrained in the market's idea that supply is not going to be there, then buyers are going to have to look elsewhere. And last time I checked, U.S. wheat doesn't look too shabby. In fact, we're fairly competitive in the global marketplace. So looking at big or improving U.S. wheat exports combined with Russia pulling back, that would be a very big driver that could take a rally beyond just short covering into the end of the year and create a more protracted move to the upside. I'd be looking at exports as a key trigger for right now.
Except I'm not sure if I believe Russia or not that they're going to put a quota on or even ban wheat at this point. Cattle market, what about that one? Okay, we're seeing a nice recovery rally or relief rally here today. Are the funds done liquidating in that market?
The way I look at it, remember, once we broke through the 2014 high on live cattle, I'm looking at the April contract. We had this big parabolic surge, and we are now back testing that top from 2014. What was once a top becomes support. This would be a logical place for the funds to stop selling, for some relief, for like a technical bounce, a rally in the market. And the same thing with feeder cattle. If you look at April feeder cattle, the same thing happened. We broke through 2014 highs, had a parabolic move, and we're now back to it. In fact, we're a little bit below it, but still within the 2014 topping range. This is really an ideal setup for the market to have an oversold technical short covering bounce in the marketplace, because it's been such a kind of a mini crash and overshoot to the downside on a short-term basis. This is a logical place for this to happen. And I think today's move is probably the early stages of that happening. And I do think we could have some further momentum. I'm not looking for retesting the highs anytime soon. I'm thinking more something like 8 to 10 cent, maybe even a 50% retracement, 15-cent rally off the lows on live cattle, something like that. That would be something I would be expecting. But I think we need to get into the second quarter and beyond, into the herd rebuilding cycle, to get supplies tight enough again against weak demand to get ourselves to where we have a shot at taking out the highs again that we saw earlier in the year.
Okay. And let's talk about energy. Crude oil has had quite a correction. In fact, some calling it a bear market now. Are we done going down there, and where are we headed?
We have this situation where the U.S. keeps saying they're going to buy all this crude oil below 70, for the Strategic Petroleum Reserve. And I don't think the market is going to allow the U.S. to fill up those reserves under 70, which means I think the 70, 75 area is a pretty solid area for the market to continue to find support and a bid. And we're now bouncing off today. I think OPEC is going to keep those supplies constrained while the economy is weak. And when I'm looking at capital flows, we've seen a lot of shorts come into the market here in crude oil in a very, very short period of time. In fact, they're getting about as short as they were before the last big rally took place when we had the unrest between Hamas and Israel. So I think for now the funds are done, and quite frankly, they might be ready to start buying some shorts back and put some geopolitical premium back on. Not expecting a test of 90.95 again, but certainly I don't think 70.75 is going to be taken out to the downside anytime soon.
And on that line, natural gas is certainly pulled back here. And do you think that market is done going down, or is this a buying opportunity?
Well, whenever you see washout trades, I mean, clearly this knockdown in natural gas over the last 2 to 3 weeks is a clear washout trade. It's a give up trade. Everybody just gave up because of this warm weather that's being projected into mid-December. All our work says by late December, we're going to enter a very cold and snowy 3-month period for the central eastern U.S. and for a good portion of the central northern European belt. And remember, last year we had a record warm Europe. We had a very warm U.S. during Jan, Feb, and March, which means that the demand for natural gas this year is going to be dramatically stronger than last year, with demand much, much better for the end user. So I think this is an opportunity for those that are in the physical market for buying natural gas, buying propane, buying fertilizer, nitrogen-based fertilizers. I think this washout trade just before winter arrives is a really interesting opportunity. In fact, we're only, I think, 60 or 70 cents off the lows we hit during COVID. So pretty cheap market with a long winter still to come that I think is going to surprise on how cold it's going to get.
Hard to believe we're down to COVID levels. All right. Thanks for joining us. Shawn Hackett with Hackett Financial Advisors. That is Markets Now.